This is Matthew Cratter from Trader University, and today I want to talk about whether the U.S. will default on its debt. Will it fail to pay back its debt? And this is the question we're always hearing. How are our children and grandchildren going to ever be able to pay off all the debt that the U.S. is accumulating? If you're interested in understanding economic issues like this, learning trading strategies that work, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So if we take a look at where the debt has gone, even over the last 10 years, back in 2010, the U.S. debt was around 13 trillion, and it's now hitting approximately 26.5 trillion. We can see how much it's gone up just in 2020. And if we look at this chart, it's really going parabolic. It looks almost like a rocket stock or a momentum stock. Now the problem with this, a lot of people will often say, well, the debt's been going up my whole lifetime. It's not a big deal. But when you look at it as a percentage of gross domestic product is just a measurement of the economic output of an economy, and it gives you a good idea of how much debt an economy can service. And in this case, if we look at the total public debt, the total federal government debt in the U.S. as a percentage of GDP, gross domestic product, we can see that it just recently hit 135%. It was really going sideways for the whole decade of the 2010s. And then with the COVID crisis and the need to do a lot of deficit spending financed by borrowing, we've hit sort of a magic number. There have been a number of famous studies over the year that suggest that once you pass 130% debt as a percentage of GDP, once you get above 130%, you really never come back. Japan would be the one exception to this. Japan has had very stagnant growth after surpassing this level. China is at a very high level of debt to GDP as well. But it's very significant when the world's reserve currency country, the US, which runs the US dollar and prints a lot of it, when it runs into trouble and hits these leverage ratios. So that's what we're going to be talking about. And the real problem with this is if we look at, these are sort of annual growth rates. So the amount that the US debt has grown over the past 12 months. And we can see that the average, we can sort of eyeball it, but the average is somewhere around between 5 and 10%, and obviously really spiking. The rate of growth of debt has gone up quite a bit in the past 12 months. So if that's growing at that speed, if we look at GDP growth has been very sluggish. Now I'm looking at nominal GDP, maybe we should look at real GDP. But either way, the growth of the economy itself has been much more sluggish. And we can see obviously in the COVID pullback here, it's just been really disastrous for GDP. And we're trying to make up for some of that with government spending right now, with deficit spending. So this is the real problem, though. When you can think about it in terms of a household. If you're growing your debt at a much higher rate than you're growing your income, we could have looked at national income, or that you're growing sort of your revenues for your family. If you want to look at the top line, you run into a problem. And once this goes on for a certain period of time, you can never really catch up. Unless you win the lottery or something. In the U.S., it's hard to see what lottery it would win, since it's really the biggest economy in the world. So this is the problem. This is the problem with compounding debt versus compounding income, or compounding the base for tax receipts. And this is why the U.S. is in trouble, and this is why we're making this video talking about what's called a sovereign default. It's when a country or a federal government refuses to pay back its debt. Maybe it stops paying interest. Maybe it doesn't pay back principal as well. The famous example that many of us lived through was the Argentina default in 2001, when they defaulted on $93 billion worth of external debt. Now, what often happens is you'll have debt restructurings, especially if the economy is not as big a percentage of global GDP. But obviously, this is much more difficult with the U.S. since it's such a large economy and large country. So there are basically three options that are open to the U.S. at this point. And we've sort of reached the point of no return. So one of these options is going to have to take place probably in our lifetimes, probably in the next 5 or 10 years, to be honest with you. And as we'll see, I believe it's really already started. It's just going to accelerate. Option 1 is a hard default, where the U.S. says, we're not going to pay you any interest. Normally on U.S. Treasuries, if you've ever owned a Treasury note, you get paid twice a year, every 6 months. So they may reach the point where they say, well, we're just not going to pay you interest this time. Check back in 6 months. Maybe we'll pay you then. So that would be one version of it. And this would obviously be disastrous to people who rely on those treasuries for cash flow. Now, the interest rates on treasuries are extremely low, but there would still be implications for this, especially because people buy treasuries, especially institutional investors, and lever them up. So you have a lot of leverage in the system on top of this. So a hard default could involve saying we're not going to pay you any interest income, or we're just not going to pay you back the full principal that we borrowed from you. So you lent us, this is the U.S. government speaking, you lent us $1,000, but we're only going to pay you $600 back. We had an example of a default when Greece defaulted on a payment, a multi-billion-dollar payment to the IMF. There are lots of historical examples where countries defaulted. Philip II of Spain is very famous for having defaulted on his debt 4 times and threw a lot of the European banking system into disorder every time he did it. One wonders why it took people 4 times to learn their lesson, but this can, as we said, this can be catastrophic to the financial system, to the banking system in particular. And we have such a financialized economy now in the U.S. It seems like everyone's either in some tech company or finance, and there's just a lot of leverage in the system. So this could be quite catastrophic in terms of the knock-on effects and the ripple effects. I'll give you a small example here. Let's say that I'm a hedge fund and I'm long. I own $100 million worth of crude oil futures. Now, when you trade futures, you can post margin, your initial margin. You can do it using outright cash, or you can use treasury notes or T-bills, quite often T-bills. And so let's say that I met this margin using, I'm simplifying the number here, I'm not really using leverage, but let's say we met this margin with $100 million worth of T-bills, which is U.S. government debt. Now, if the government does a hard default, if the U.S. government does a hard default, all of a sudden my T-bills are only worth, they said you lent us $1,000, you're only going to get $600 back. So in this case, my $100 million worth of T-bills are only worth $60 million. And so I'm going to get a margin call from my futures broker. I need to sell off $40 million worth of my crude oil holdings. And so what you get these sort of knock-on effects across the financial markets. You get a crash in commodities. You probably get a crash in stocks as well. And this would be especially catastrophic because the US dollar is the global reserve currency. We would certainly see global economic collapse. We would see famine. We would probably see war as well. So this would be extremely serious. This one just be like Philip. It was bad enough when Philip II of Spain defaulted, but this is, now we're talking about a global economy that has a lot of leverage and a lot of interconnections. If, for example, the government doesn't pay you back on your treasury position, which is considered the safest investment around, all of a sudden you might not be able to pay your employees. You might not be able to pay your mortgage. You may have to lay everyone off in your business, etc. So as I said, there are all these butterfly effects. Option 1, a hard default, I don't think it's going to happen. It doesn't make any sense, especially when you have the world reserve currency. You can always print money and pay people back. But this is a hard default where the U.S. government or any government just says, we're not going to pay you back. If you're gaining any value from this video, I'm just going to pause here really quickly to ask you to please subscribe to the channel. I've noticed that only a small percentage of my viewers actually subscribe. So if you can just click that red subscribe button, it'll really help me out. Option 2. So option 1 is a hard default. Option 2 would be austerity measures. Austerity measures, this is very similar to a household. If maybe you've been living a little too much off of credit, you reach the point where you decide you are going to start living within your means. And what this means for the U.S. government is that it can only spend what it brings in taxes. So what would have to happen is the U.S. government would have to cut spending and raise taxes. If we take a look at the debt clock here, current spending is, if we go over here, 6.6 trillion official, and it looks like the actual spending close to 7.7 trillion. U.S. government only bringing in $3.4 trillion in tax revenue. So what this means is that the government would need to increase taxes to bump up the revenue number, and then cut spending to sort of bump down the expense number. This would be what's called austerity, and basically the one big problem with this is when you cut government spending and raise taxes, you actually will often end up shrinking the gross domestic product, the GDP, and in this case, that will make all of your debt ratios worse. So falling GDP, the debt will stay the same, the GDP will fall, and so the ratio will get worse. Another problem with this is a huge chunk of that U.S. government spending that we just looked at is paying things like Social Security, defense, Medicare, all the entitlement things, paying interest on the debt as well, and also all the stimulus checks, all the stimulus that's been done in 2020. So the problem with austerity is it's, first of all, very politically unpopular. It can also be dangerous. If you're a retiree and you're depending on Social Security, you might not be able to pay your rent. You might not be able to buy groceries. And so as a result, austerity, it usually doesn't last too long unless you have a dictator. You end up with riots, a lot of social unrest, people starving in their homes, people living in the street. And in a democracy, or a pseudo-democracy as we have in the U.S., any politicians that impose austerity will be quickly voted out. So we have a 2-year cycle or a 4-year cycle or a 6-year cycle, depending on the office you're looking at. But austerity is very, and Americans are used to living fairly high on the hog on average over the past 50 years. So you can't really see, you could see austerity maybe in an Eastern Bloc country or somewhere where people are used to a little more suffering. Could never happen in the U.S. And so that would be option 2. Finally, option 3 is what's called a soft default. And in a soft default, the government defaults on its debt, but in a very sneaky way. It basically devalues its currency so that it can pay back all those dollars worth of debt using this depreciated currency. There are different ways you can do this. You can basically have debt monetization, which is what's happening right now in the U.S. The Federal Reserve is buying treasuries and in that way helping to subsidize government spending. The U.S. government could never be spending what it is now if we didn't have the Federal Reserve taking down all the debt that the U.S. Treasury issues. You can have quantitative easing as that is. You can have UBI. You can have some sort of helicopter money, universal basic income, where people are starting to get free money. There are lots of ways to sort of stimulate inflation and also devalue the currency. But the basic principle of a soft default is you pay back that debt using devalued dollars. So if I lent, in the example we were using, I lent $1,000 to the U.S. government, they will eventually they will pay me back, but they will pay me back in U.S. dollars that are not worth as much in terms of their purchasing power. So when I was a kid, classic example, Big Mac was like 25 or 30 cents. Now it's more like, call it $5 or so. We've had a lot of loss of purchasing power of the U.S. dollar. In 1970, if you were making $5,000 a year, you were really well paid. Today, that would be obviously sub poverty level. So the U.S. dollar has lost purchasing power against real things in the real world. I'm not talking about the Dixie here or various fiat exchange rates. We're talking about what a currency buys you in the real world. And so this is what happens in a soft default. It hurts those who are on fixed income, who own bonds. If you own a U.S. Treasury and the coupon is paying you something like 1% a year or 0.8% a year, and the currency is going down by more than that, you're actually losing wealth over time. If you're sitting in cash because you're very worried about a real estate market crash or a stock market crash or something like this, you are getting hurt by a soft default. And this is what I've been talking about. I get a lot of people on my channel, a lot of commenters who think that they're protecting themselves by hiding in bonds or hiding in cash and just trying to time the stock market here or time Bitcoin or time gold. And what they don't realize is that the U.S. is currently doing a soft default as we speak. And anyone who's been in stocks, real estate, gold, Bitcoin this year, they know that these have done quite well, and anyone who's been owned any of these in the U.S., their wealth has gone up. Those who have kept their assets mostly in cash or in bonds, i.e. fixed income, they are being hurt by soft default. And this will just continue. What happens in a soft default is that if you have a fixed or limited supply asset, Bitcoin's a great example. There are only 21 million Bitcoin, but you could talk about real estate in a good metropolitan area or something like this. The price of these assets will go up when U.S. purchasing power goes down. And the downside to this is that a soft default, any sort of quantitative easing, trying to devalue the currency, will increase wealth inequality. Now, this is what's been happening. This is why when you take a look at the chart of Bitcoin or the chart of gold or the chart of the QQQs or the S&P 500 this year, we can see that this is the route that we're going. We're not going to have a stock market crash. We're not going to have a real estate market crash. Instead, we're going to drive up asset prices through a soft default. Why do I think option 3 is really the only option? Well, if we take a look at it, in a hard default, as we said, you end up with war, famine, global economic collapse, just huge uncertainty. So that will definitely not happen. That's just too bleak. Austerity can just never happen in a democracy. And even in dictatorship, it's still difficult because you get a lot of social unrest. You get people starving, as we said. If we did true austerity measures in the U.S., given how dependent people are on the U.S. government now, we would literally have a replay of the Great Depression. I have no doubt of it. We would have people living in tent camps, and we would have, I'm not sure if we'd have dust bowls, but we'd probably have that as well. So austerity, we could try it for a year or two, but anyone who tried it would immediately be voted out of office. I'm trying to think, the only kind of politician who could really do austerity would be a president in his or her second term, but even then, they might be afraid to do it simply because it would be so unpopular and it would destroy their sort of historical reputation. And so if you can't have a hard default and you can't have austerity and you're growing your debt at a much faster rate than you're growing your GDP, you really don't have a choice. You have to go for the soft default. And I think that this policy decision has been made in the US. This is one reason I'm so bullish on stocks. I'm so bullish on real estate, Bitcoin, gold, etc. Because in a soft default, it looks like the economy is still healthy. You get the stock market going up, you get real estate prices going up, and hopefully they go up enough to compensate you for the devaluation of the currency. If the S&P 500 goes up 10% and the currency is devalued by 15%, you're obviously losing ground. This is one reason I like Bitcoin, simply because it's has such a fixed supply, only 21 million coins, that I think it does the best of any asset class in a soft default. So the nice things, the quote-unquote nice things about a soft default, stocks, real estate keep going up. It looks like the economy's healthy and the rich get richer. And politicians themselves are usually quite rich, or they're dependent on rich people. And as the rich get richer, they make bigger donations to politicians and help keep them in office. If you're a politician, it's political suicide to try to do austerity or a hard default. And so soft default is the method that will be taken. We will pay back our debt. Our grandchildren don't have to worry about it, but unfortunately the US dollar will lose a lot of purchasing power in the process. And we may actually never pay back all this debt. We may just keep expanding it, issuing new debt to pay off the old debt. But either way, there won't be a hard default. There won't be austerity, but there will be a soft default. And we know this because the Fed is already laying the groundwork for it, saying that they are shifting the way they deal with inflation. They're willing to let inflation run a little bit on the hot side. And as a trade-off, they'd rather have more inflation and then have lower unemployment, rather than really controlling inflation and then having a whole bunch of unemployed people. But this is sort of the official rationalization of it. But what's really happening is we are going to inflate our way out of our debt. We're going to devalue the dollar and use those devalued dollars to pay off debt. This is one reason I think the stocks will keep going up for the next 10 years, and one reason I'm extremely bullish on Bitcoin. I think we see $100,000 by the end of next year, maybe even $200,000 the way things are going. And if you think we're going the route of a really strong dollar versus hard assets, or the route of a hard default or austerity, we have a lot of dollar bulls who seem to think in these terms. You have to explain the chart of gold and the chart of Bitcoin and the chart of stocks this year. And I think they just demonstrate, especially Bitcoin, really demonstrates that a soft default is what is happening for the US. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell so you can be notified when I publish my next video. And let me know your questions and comments about this video. Thanks a lot for watching, and I'll see you in the next one.